So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to grow your wealth. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate investment minds in the world, as well as financial advisors, passive income wealth advisors. And really the goal is to help bring clarity to different tax deferral options and also ways to grow your passive wealth, especially through investment real estate, which is at the heart of where I started my career at Marcus & Millichap, and also where I love to invest. So with that, I'm so honored to bring on a guest for the second time. He's actually, I think, the official first person to be on for the second time. And it comes at an opportune time in that we're seeing a big shift in what's happening with COVID-19. And COVID-19, we believe, could present some real opportunistic multifamily investments coming up here with some distressed sellers. And it could be the next 3, 6, 12 months. And Brian Burke is here. You can hear his first full story at our previous episode. Just check that one out. But in the meantime, we're going to dive right into what he's seeing and what his fund is poised to do. So please welcome to the show with me, Brian Burke. Hey, Brian, how you doing?
Hey, great to be here again, and quite an honor to be the first one to be a two-timer.
It really is, right? When we only have 20 episodes or so launched, it actually really is. But what's really unique about that is you're in Santa Rosa, I'm in Sacramento, right? We're just a couple hours away from one another, and you're in the multifamily space. That's where I started my career at Marcus & Millichap. There's a lot of synergy here, and we have after we talk a little bit, we're going to talk about a deal that actually Brian and I are serving a co-client together with the Deferred Sales Trust. So that's a little sneak peek. But in the meantime, Brian, let's dive right into what you're seeing right now in the marketplace. And what are some of your, I guess you could be maybe predictions or anticipation for opportunities coming up?
Well, obviously, we're in the midst of the COVID-19 pandemic, right? So that threw the economy and real estate into a bit of a tailspin because you have business closures and job losses. And, job losses resulting from the business closures are resulting in some economic distress in real estate, and businesses that are closing are creating economic distress in real estate if they occupy commercial space. So, it's kind of put real estate a bit in the crosshairs. And right now, I'm seeing distress starting to materialize, especially in like the hospitality sector. I think that, along with office to a bit lesser degree, and retail maybe to a greater degree, being pretty negatively impacted by what's going on, which ultimately is going to result in a pretty long and lengthy recovery for those sectors. But at the same time, I also look at residential assets and apartment complexes, single family homes. The residential sector seems to be holding up remarkably well so far to all of the chaos. I think it's going to deflect the worst of the damage, but make no mistake, there will be damage in those sectors. It's going to cause some limited distress, and that's going to result in some buying opportunities. And I also think that once we kind of pull through this cycle, some strength will return in some markets more so than others, and just gives us a chance to take advantage of some of those demographic shifts that are resulting in rent growth. At the same time, we can take advantage of a negative economic cycle to present some pricing adjustments and buying opportunities. And it's not too often you can put both of those two factors in play at the same time. So it's an exciting time right now.
It really is. And I'm curious what you think. So we both live in California. Like we mentioned, you're in Santa Rosa. I'm in Sacramento. And California apartments have been through the roof for really a while now, at least the last 2 to 3, 4 years. I've had a tough time having any clients actually purchase in California. And when they sell, that's part of why we do the deferred sales trust, because I have a tough time having them 1031 and getting buried and overpaying for property. So let's focus on California for a second and multifamily, and share with those listeners what your take has been on the valuation and the pricing for multifamily in California.
Well, I think it's a great time to sell. Sell and get out of your California assets. Give Brett your money so that he can save you for some taxes. But I can't find any reason to own California real estate right now. Personally, it's not the economy that I'm as worried about. I'm not as concerned with COVID and the results in California. The recovery forecasts in terms of rent growth in California are pretty robust, but the continuous drumbeat of regulation, rent control, eviction control, all of that stuff is going to make investing in real estate here pretty undesirable if any of that actually takes root. Making matters worse, from the other side, at the same time, regulators want to limit how much you can charge. They also want to increase how much you pay by rolling back elements of Proposition 13, creating a split property tax roll, which would increase commercial property taxes significantly. So I just think that before any of that all comes to a head, sell now while values are still really high, and deploy that money to states that actually want your business and want your money versus states that really don't want your money.
Yeah, to be honest, it's just a matter of mathematics and regulations, right? And at a certain point, these prices, you go, these 4 caps, these 5 caps, where the rents have been, highly pressed up. You go, when is all of the regulation and all of the challenges and all of these companies that are leaving California, when is it going to catch up with them, right? And I don't want to be the person, sitting in the chair when the music stops, or losing that chair, like musical chairs going around. Like, sell now, right? Diversify now, get out of California. So that being said, you've owned and I think have managed thousands of units, right? And you got out of California a while ago. So talk to us about where you think the opportunities might be coming to, A, and then B, what markets are you focused in, and what is that going to look like, by the way? Because I get a sense that it's not going to look like what we did in 08. When 08, where a bank would foreclose and then someone would take it. I get the sense that it's going to be more like working out between a seller and a bank, and maybe having the bank take a little bit of haircut and the seller taking a little bit of haircut, and kind of just repositioning the paper. But what is your take on what we're going to see here?
Well, I think in terms of California, not a lot good is going to happen, but I was studying rent growth patterns across the U.S. and ran across a lot of really interesting data. And from what I'm finding from my analysis of the raw data is that markets in Arizona, Nevada, Florida, the Carolinas, and Tennessee and Georgia are going to outperform not only the country, but almost everywhere. Intermixed with some of those high performers, though, are some of the usual suspects like San Jose, San Francisco, Seattle, and some of the Central Valley California markets like, I've seen not only Central Valley, but like Salinas, Fresno, Bakersfield. Some of those markets are scoring pretty high in post-COVID recovery rent growth forecasts. The difference that I see, though, is that the first group of states that I mentioned are business-friendly states. They're states where people are moving to, not moving from. There are states that have landlord-friendly laws, which mean that you're going to have an easier time managing your real estate business in those states, contrasted to California, which, while some California markets are right up there in terms of post-COVID recovery rent growth, you still have the threats of all this overregulation and increased property taxes with any Proposition 13 rollbacks that may come into play. And at the same time you have that threat, you have the parallel threat of mass move outs. I mean, if you don't know someone that's moved out of California, I guarantee you know someone that wants to move out of California, and everybody talks about moving out of California, whether they actually do or don't. The question is, how many people do you know that talk about moving to California? And that probably not very many, and neither does U-Haul or Penske, who are the truck rental companies that put out statistics on where the one-way rental trucks are going. And they're not going to California, on our home state, Brett. They're going to places like Arizona, Texas, Georgia, and Florida, and the Carolinas. That's where they're going. I like to say that if you want to make money in real estate, you got to go where the population is going. And if you go where they're leaving, that is a really risky place to be. So despite the fact that post-COVID recovery forecasts are strong in California, all of this other noise, it increases the risk that you're going to accept in order to hopefully achieve those returns.
Yeah, so well said. You could write a few books on that alone. So now let's dive into the opportunities now, right? So we got the basis of what's going on in the landscape here. But walk us through again how do you anticipate what kind of distress we're going to see? What's it going to look like as actually executing and being able to take advantage of what we might see?
So I've been through a lot of market cycles in the 30 years I've been investing in real estate, and the deepest one is the most recent one, and that would be the 2009 Great Financial Collapse, or I actually call it the 2005 Great Financial Collapse, because that's when it really started. The seed or the fuse was lit in August of 2005, and it burned really slowly until about 07, 08, 09 when the bomb exploded. That's what people think of when they think of distress and distressed real estate. They think, I saw prices go down 30 to 60% in various markets. I saw deals to be had everywhere, for sale signs on every corner, distress everywhere, opportunities that were like drinking out of a fire hose. That's what people think about. I don't expect to see that this time around. If you're looking for that as a barometer for the amount of distress, you're going to be sadly and sorely disappointed. Overall and fundamentally, the real estate economy is performing fairly well. The challenge, of course, that we have is through job losses from COVID. That's temporary. It's going to create some real distress. Now, real distress means an individual owner that's over leveraged is going to have some difficulty making their mortgage payment. They get foreclosed. Their investors lose all their investment. The bank just cuts their losses and sells. Those are going to be few and far between, but they're going to be out there. The challenge is you've got hundreds of billions of dollars sitting on the sidelines waiting to buy those opportunities if they just come down ever so slightly in price. So they don't, you're not going to see these 20 and 30 and 40 and 50 and 60% price reductions, but you might see a 3%, a 5% price reduction. You might see some slack in cap rates. You might see some markets like Las Vegas that were disproportionately affected because of the high concentration of service sector employees that's creating some negative rent growth there for a couple of years that will lower NOI at commercial properties and at the same time have cap rate decompression, which will result in some change in valuation followed by a pretty robust recovery that's going to bring it back. So the question isn't really, how many properties are going to fall into stress. It's really how many owners can just hang on to get through the other side because they were properly structured and leveraged versus how many of them were improperly structured that end up imploding. And I don't think it's going to be anything like what we saw in the Great Financial Collapse.
Yeah, I think that's so well said. Improperly structured and leveraged, right? Taking on too much debt and that would be, I guess it'd be A, right? Too much, but maybe clarify that. But also maybe clarify properly structured. What is it about Praxis Capital and the way you guys structure it to try to be as, sound as possible?
Yeah. So as far as leverage goes, the thing that kills everyone in this business, you look back to, the Great Financial Collapse, the people that lost their property, whether it was the homeowner at the corner or whether it was the commercial property owner in downtown. In almost every case, those people were over leveraged, meaning they owed too much money on the property. And, for us in our business, it was great. We bought about 600 properties during the great financial collapse at foreclosure auctions. And I can tell you, out of the thousands and thousands of properties that we followed and tracked through the foreclosure process or bought, at least 98% of the cases, at least, if not way more, they were encumbered by more debt than the property was worth. And that meant that the banks were selling and cutting a loss just on the principal balance of their loan. So, nowadays you don't see that quite as much, but that's the big risk, is having too much debt and people borrowing too much. So where you saw this in the multifamily space is people that were using high leverage bridge debt, 90% to cost money, financing their improvements, that sort of stuff, and doing that portfolio wide. Some sponsors, we have a couple properties that we have under that debt structure for a specific reason. But some people built an entire portfolio on that kind of debt. And if they have, half of their portfolio starting to go into negative cash flow, there's no saving it. And they're going to implode.
So to clarify, what you're saying is they're cross-collateralized with bridge financing across multiple properties, and that's how they've built this. And if even just a couple of these start to go, then it's all going to go.
Sometimes they are cross collaterals. I've seen that, but generally they're not even. Sometimes they just get 90% debt at a high interest rate, but they repeatedly do it over and over and over again. So they buy all the properties in their whole portfolio are financed that way. These notes are going to start coming due in a year, maybe 2 years from now, and they're in negative cash flow because they're suffering from tenant losses and evictions and that sort of thing. And then they have a higher interest rate and they just can't get out of it. There's really no escape. Mm-hmm. So, that's one element of using improper debt, but improper structure comes from a lot of different ways. One is these loose-knit partnerships of groups that kind of get together to go buy deals. And they're not really a company. They're just a bunch of different JVs buying quote unquote deals. And, these partners, they haven't been in business together for very long or even on very many deals. They might not be in all the same deals together. And when things start going south and the going gets tough, that's when people's character really shows through. And then they start falling apart. And now, the guy that was really the one that knew what he was doing, he's gone. And you've got these other guys that have no idea what they're doing, are left at the helm of a sinking ship, and they don't know how to navigate their way out of it. The other structural error that I've seen is people taking on way too much preferred equity, where they say, you have a preferred class of equity stock that gets a guaranteed return. And then your equity investors are subordinate to that. And that's a difficult challenge because if the values don't increase and you can't refinance your way out of that debt, you could be stuck with them taking over the project and kicking your investors out. So that's another way people can lose money.
Okay, make sure I capture that. So one of them would be just lack of track record for the core principals or the people that you're entrusting your wealth with, right? Mm-hmm. To be either a limited partner or a silent partner on the side, and as the stress starts to come, right? It's like Warren Buffett, when the tide goes out, you see who's been skinny dipping, right? If they don't have this core foundation of this company, it's kind of put together, if you will, like a startup company, and then the main core person leaves, then it becomes very difficult, right, to continue this deal, this opportunity that they were chasing, right? So that's A. Is that a fair summary there?
Yep, that's right, exactly.
Okay. And then the second one, just the actual structure of the deal, meaning it's not incentivizing for the operator. He's counting on appreciation and the ability to refinance. In other words, the preferred equity or the guaranteed equity, right? It's a big promise, and as long as things are going well and the tide's still rising, then we're good. But as soon as it goes back out, the sponsor's going, I'm doing all the work, I'm giving all the money away, I made a bigger promise than I should have, right? Or could have, right? But I was banking on things continue to go great, and now he has no incentive to keep it going. And is that a fair summary on that one?
Yeah, that's a fair summary of one element of it, but there's another element too, where sometimes the investor that has the preferred position actually has takeover and control rights. So if they don't get paid their guaranteed return, they can kick the sponsor out, and they can kick out the subordinate equity investors as well and take over the property. So then the investors that were investing in the common equity completely lose their entire investment and have completely lost control of it. So there's two components to that, where the sponsor can become disinterested, or the sponsor can just flat out get kicked out.
Yikes, that's even scarier than I thought. So now let's put it back to Praxis Capital and these potential opportunities, right? So fast forward 6 months, a year from now, 3 months, you find a deal 3 to 5%, off of what it might have been. You identify it in probably Arizona, Texas, Florida, Tennessee, the Carolinas, and now you're going to purchase it. What would be the way that you would purchase it? And by the way, we're going to be talking about credit investors. Okay, I believe that's the way Brian positions it. But just give us kind of the overview without divulging too much, where it's going to put any of us in trouble.
Right. Well, we recently launched a fund, which is a fund using the 506C exemption, which means that we can actually advertise it as long as we only accept accredited investors, and we prove that the accredited investors are in fact accredited, which for the first time, this is only the second time we've ever used this exemption, by the way, but I had a book that came out recently, and we just felt that with the exposure that the book brought, it was safer for us to use the 506C exemption just to make sure we're staying on the right side of the law. But it does present me the unique opportunity of being able to talk a little bit more freely about what we're doing, instead of basically having to speak in tongues about our real estate opportunities because we can't advertise them. But what we've done is we've launched a fund. We're raising $25 million to acquire multifamily assets in those markets that I mentioned to you. We might raise a bit more than that depending upon demand. But the fund's objective is to acquire, in growing markets that have population growth, that inward migration and movement. We want to be in front of the demographic cycle, which is, that population movement, and not as focused on the economic cycle, because we already know we're in an adverse economic cycle. So if we can find the right markets to invest in, and we believe that we have, our objective is to use the temporary pricing dislocations that we're seeing in the market, small as they may be, to our advantage to acquire in those really strong growth markets. So we figure this fund will get us through our 2020 acquisition platform, and then maybe next year we'll do another one. But our objective is to look at that kind of 100 unit and up, Class A minus through Class B minus multifamily asset in those strong markets.
Awesome. So let's talk about your other fund that you have, which is hard money lending, and then let's connect the story here with a co-client, which we promised the listeners. So talk to us a little bit about what that has been and how that's worked out so far.
Yeah, we have a lending company that some may call it hard money lending, some may call it private money lending, whatever you may call it. We make loans to real estate investors through our subsidiary Riverbend Lending. This company does fix and flip loans, commercial property, bridge loans, and that sort of stuff. And the way we've funded those loans initially is through an investment fund that we created for our investors to invest in. It's been a great fixed return kind of coupon fund for our investors. The reason that we did it was because we have a variety of needs from our clients, where some people, they want that 18% IRR, hair on fire, risky, opportunistic type of investment return. We have some that just kind of want that steady as she goes, low teens type return on value add, stabilized assets. And we have some people that, just want a coupon. They just want a fixed return, just like a CD, that type of thing. And we wanted to be able to offer investment products throughout that spectrum for our clients to satisfy their needs. And this fund just satisfied that particular need for that coupon style fund.
Excellent. Yeah. And so to that point, I I think I cold called Brian, by the way, like 10 years ago or 5 years ago when I was really focused on multifamily brokerage and was calling a lot on cold calls. And but I don't think you were buying or whatever that was at that point. But the point was, back up, I spoke with a gentleman. His name is Dave. He's actually a co-client of ours now. And so about a year and a half ago, I sit down with him. He's like, "Yeah, you know Brian Burke?" I was like, "I remember the name." He goes, "Yeah, I've invested with Praxis Capital at the time." He told me a little bit about that. So he's kind of actually been a long-term client of yours. But fast forward, he's selling a $7.6 million property in Georgia, 128 units. And his exchange is failing, right? And he can't make sense of the numbers. And COVID-19 hits. And so he's past his 45-day identification. And he's like, "You know what? This deferred sales trust looks a whole lot better now that COVID-19 is not here." And he's done hundreds of sales and numerous 1031 exchanges. So for the first time ever, he did a deferred sales trust. He put $3.1 million into this trust. And the cool part was, he's like, "Brett, there's a place, Praxis Capital, remember them?" Yeah. So a big percentage of that went with you guys, and he was getting the 6%. For him, he wasn't like a stockbroker guy, right? He doesn't really like stocks, bonds, mutual funds. He's not big on that. But he is big on real estate, right? And so he was able to, what people might think is not possible, sell, save a failed 1031 exchange, pay off all the debt, and then move it into something that's a little more predictable, a little more diversified, also very passive for him. He literally has to do no more toilets, no more trash, no more liability. And it's been a real nice, seamless fit. So would you just speak to a little bit about that and maybe some misconceptions when it comes to people not thinking outside the box, and or what is a way that you vet things to make sure that people are asking the right questions about things that are new and maybe have never heard of?
Yeah, it's interesting because I get a lot of questions from people wanting to know if they can invest 1031 exchange funds into our syndicated offerings. And the answer has always been no, you can't do that. It's not like kind to exchange real estate for shares in an LLC. So it's always been a bit of a challenge. In fact, I've had two people just today ask me this question, if they can invest 1031 exchange money into a syndicated offering. And, I've heard about a variety of ways that 1031 exchanges can be utilized and manipulated to invest in things you wouldn't think that they would be able to invest in. And I've always dismissed it essentially as a bunch of bunk, that, somebody's got some black box that, who knows if it's even legal. But I'll tell you, you made me a believer when we got the wire from our mutual client who made this work. And it was a real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
Well, thanks for sharing that. That means a whole lot coming from you and your background. And likewise, when I was doing 1031 exchanges with clients of multifamily properties, and I still do, it took a while to like, does this really work? And I liken it to like riding a bike, right? The first time you ride the bike, it was a bit wobbly, but once you ride the bike, it becomes comfortable. A lot of my clients, the first time they did a 1031 exchange, even in the 1980s, people were like, is this thing legal? Does it work? And how does it work? And skepticism. But now fast forward, there's so many exchange companies educating people. It's second nature now. And the last part about that, just to clarify too, so we're actually not doing a 1031, right? So you're absolutely right on your structure, especially in California, drop-in swaps or trying to do, fancy ways to trade real estate and then non-like kind into shares of an LLC. We also believe those don't work. And that's why we're not using that tax code. That's IRC 1031. We actually use a different tax code, which is called IRC 453, which is known as an installment sale. And so we liken this to the old Blockbuster is like the 1031 and to the Netflix. And as a seller carryback, as soon as you go into that mode, you no longer have to do like kind. Right? You can put it in stocks, bonds, mutual funds, hard money lending into a business, develop real estate. We just closed a deal in Alabama, $2.2 $1.6 million sale, $600,000 of liability deferred. And these guys were in the marketing business, and they actually want to be in the multifamily development business. And guess where they're developing real estate? They're developing 80 units with the Deferred Sales Trust funds that they would have paid to the government in Tennessee. Okay, that's where they identified as a great market to develop. So it can be done. It has been done, and we just can't get the message out fast enough. So I appreciate that. Any thoughts on that, or any follow up on that?
Well, my thoughts are that that's just really, really cool. It opens up a whole world to people. And, this may not have mattered in 2009, 10, 11, and 12, when people weren't selling highly appreciated real estate. They either weren't selling it because they had no equity, or they weren't selling it because they didn't feel that it was a good time to sell. But from about 2014 on, when we started to notice an increase in people looking at 1031 exchanges as a result of the fact that they had equity in their real estate and were realizing their return on that equity was infinitesimally small. They were earning nothing. They had millions and they were earning like 0.5% on the equity when it's sitting there in this highly appreciated real estate, and they needed a way to unlock it. And 10 years ago, it didn't matter. They didn't need a way to unlock that, and they wouldn't want to even if they had a way. So it's very timely what you've been able to put together for people. And like I said, it made me a believer when the wire hit our account.
Yeah, absolutely, right? Until the deal closes, it's not there and it's not real. But what's cool is thousands of closes now, 25-year track record, and we literally have some of the best tax attorney, CPA, and financial advisors we work with. But that being said, I want to put this stat to you too, just to think about, Brian. It's the baby boomers. It's according to the American Bankers Association. There's about $17 trillion that's going to pass from one generation to the next in the next 20 years. And it's known as the largest wealth transfer in the history of the world. Okay. And so think about it, 17 trillion, it's probably upwards of 20 trillion now with the way the stock market's gone. But all of that wealth is going to transfer. And talk about government regulation and what that could mean if people are actually paying tax on that, which is massive, or using a tax deferral strategy. So that includes primary homes. That includes highly appreciated stock, right? A 1031 only works for investment real estate, right? And we just did a deal in Cupertino, $3.1 million sale, and we helped her defer $400,000 above her 121 exclusion. So can you speak to just if what we're saying is true, which I'm a believer and you're more of a believer every day, but just outside of the commercial real estate world, if a lot of folks are just focused on people 1031ing into their syndications as another deal, right? Which they may or may not be able to do. But if you can open up for example, we're doing a Bitcoin case right now, $5 million Bitcoin case. We're doing a $1 million Tesla stock sale. We've done Netflix, stock sales. But if you could open up all of those other asset classes to essentially sell, move into a deferred sales trust, and then either fund into, your LLCs or fund into your hard money lending, what would that mean when it comes to this $17 trillion wealth transfer?
Well, my joke would be that it means you're going to bankrupt the U.S. government by withholding all their tax money, but you're certainly going to empower the people that otherwise would have paid to make some significant investments. That's for sure. So, maybe that's one of those what goes around comes around kind of deals, right?
For sure, right? And to that point, right? Why does the government allow this, right? Why don't they just cut us off? And with the 15 IRS audits, they've gone through that. Well, it's a study of macroeconomics. They actually spur economic growth, which spurs job growth, which spurs more tax revenue. So it's in their favor to do that. And also, too, Joe Biden, I don't know if you saw this, but he recently, he's campaigning or announcing that he may take away the 1031 exchange, right? Yeah. I've got a number of texts from people, and they're like, hey, Brett, you're in a great position if he gets elected and this goes through. And I'm like, yeah, we'll see. But to that point, IRC 453 goes back to the 1920s, and the reason they put it in is part of the depression, everything that was going on, that they wanted to make the people have the ability to be the banks, right? So IRC 453 is a seller carryback, and so when you do that, you can keep the economy going. Think of like 08 when the banks everything was kind of collapsing. If the government has to become the bank, guess what happens? It's not good for anybody. Like everything kind of stops. So they want to incentivize private companies and private banks, and then also people in case something like a COVID-19 or like the 2009 crash, right, happen, that people can still do commerce and they're still incentivized to sell without getting wiped out by the tax by carrying paper, right? So does that make sense, Brian?
It all does. Yeah. And in fact, we used to talk about this back in the late 80s and early 90s when I first started investing in real estate. I remember the whole installment sale method to try to convince a seller to sell their home because they could sell it to you and carry back the loan, and they wouldn't have to pay tax on the whole sale at the time. And gosh, I mean, that's been around forever because I used to use it back in the day when I was just trying to struggle to be a real estate investor.
You got it. Exactly. And that's the foundation of our structure. So enough about that commercial. I appreciate that belief, Brian, and sharing your perspective. It means a lot. But now let's just wrap it up here. So if someone wants to be, they're accredited, and if you don't know what an accredited investor is, just go to Google and look that up. But assuming they are, Brian, and what would be the best way for them to say, yeah, I want to check out what Brian has to offer, and maybe even the hard money lending fund too? What would be the best place for them to connect with you?
Well, the best way, if you want to learn more about the fund, is if you're an accredited investor, just visit the website investwithpraxis.com, and that'll take you right to our fund landing page. There you can watch the webinar that I just did earlier today, describing the opportunity, and you can even express interest in investing in the investment right there on that website. And we can invite you into the data room to be able to learn more. If you're an accredited investor, it's a great way to learn about it. Of course, if you're not an accredited investor, you just kind of want to follow what we're doing. Our website is praxcap.com, or I'm on Instagram at Investor Brian Burke. You can find me there. And, we're always talking about something that has to do with real estate somewhere along the line.
Yeah, we love it, right? And always learning, always challenging, always growing. So, Brian, I want to thank you for being on the show, sharing your wisdom, so insightful and all your thoughts. And it's been fun sharing this co-client here. And I hope to bring you more deals and more capital as the Deferred Sales Trust business grows. And if you're listening right now and you're selling a highly appreciated primary home, business, commercial real estate, again, cryptocurrency, we've done dentists, veterinarians, optometrists, car dealerships, anything that's highly appreciated. We really would love the opportunity to show you what we do. Go to capitalgainstaxsolutions.com, schedule your free 30-minute consultation, download our ebook, Sell Your Business or Real Estate Smarter in 9 Steps. And with that, please share, rate, review, and subscribe. We so appreciate it, and make it a great day. All right, that's it. That's a wrap, Brian. Thank you so much.
Nice, man.
There's some people I have on the show, and I feel like I have to dumb it down. Me, I'm having to step my game up. You know what I mean? I'm like, okay, I got to think of good questions so Brian's just not bored out of his mind, right? But I so enjoy working, having a chance to work with Dave Levinson with you, and then likewise hearing all your insights. So thank you so much for that. And I didn't expect you to say all those things, so it means a lot.
Yeah, well, I appreciate you having me on for the second time. To be your first number 2 is great. So thanks for having me on again. It was a real pleasure. I wish you a lot of luck and success. Hopefully we can refer you some clients, and likewise. Yeah. And just look forward to doing some more business together, Brett.
Perfect. Thank you, Brian. Have a great day.
Yeah, you too, man. Thank you.
Bye.
All right. Bye-bye.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.